I want you to stop whatever you are doing right now and listen to me very carefully, because what I am about to tell you in the next 10 minutes is going to either completely change the financial trajectory of your life, or you are going to scroll past this video, go back to paying someone else's mortgage through your rent check every single month, and wonder 5 years from now why everyone around you seems to be building wealth while you are still stuck in the same cycle. There is a 26-year-old in Austin, Texas right now, making $58,000 a year, who just closed on his first property last month. There is a 27-year-old nurse in Ohio who bought a duplex, moved into one side, and now her tenant is paying $800 of her mortgage every single month. These are not lottery winners. These are not trust fund kids. These are people who learned something specific, executed something specific, and got out of the rental trap before their 30th birthday. And by the end of this video, you will know exactly what they know. But before I give you the roadmap, I need to show you something that is going to make you genuinely uncomfortable. Pull out your phone right now and open your bank app. Look at what you paid in rent over the last 12 months. Go ahead, I will wait. Whether that number is $14,400, $18,000, or $24,000, every single dollar of it is gone forever. No equity, no return, no ownership, just gone, directly into your landlord's net worth while yours stayed exactly the same. And here is the part that should genuinely keep you up at night. The average American renter between the ages of 25 and 34 will transfer somewhere between $150,000 and $200,000 in rent payments to a landlord over a decade, and walk away from that decade with absolutely nothing to show for it except a slightly worn couch and some memories. That number right there, that is your motivation for the next 10 minutes. Do not touch your phone. Do not skip ahead. Because what comes next is the chapter-by-chapter breakdown that nobody in your family probably ever sat down and explained to you. Let me be completely transparent with you about what is actually happening in the American housing market right now, because the mainstream narrative you are hearing from news channels and social media is leaving out the most critical parts of the story. Yes, median home prices have crossed $420,000 nationally. Yes, mortgage rates have created monthly payments that feel genuinely out of reach for someone making under $80,000 a year. Yes, inventory in desirable cities is so compressed that bidding wars are still happening in markets where common sense says they should not be. All of that is real, but here is what the doom and gloom headlines consistently fail to mention. The people who are successfully purchasing property under 30 right now are not doing it in San Francisco or Manhattan. They are identifying secondary markets, mid-sized cities, and emerging suburban corridors where median prices are sitting between $180,000 and $280,000, where remote work has made geography almost irrelevant for a growing percentage of the American workforce, and where appreciation trajectories over the next decade are frankly more compelling than the oversaturated coastal markets that everyone is conditioned to fantasize about. The game did not become unwinnable, the game changed its geography, and the buyers who understand that are the ones getting keys cut while everyone else is still complaining about the market on Reddit. Your first move is not saving money. Your first move is completely reconditioning how you think about where ownership is actually achievable right now in this country. Here is the cold, brutal reality that most first-time buyers discover approximately 60 days too late. When you are sitting across from a loan officer, when you have found the property you actually want, when you are emotionally invested and ready to move forward, that is the absolute worst possible moment to discover that your financial foundation is not lender-ready, because fixing the problems that disqualify you takes months, sometimes an entire year, and the market does not pause while you get your numbers right. So let me tell you exactly what a lender sees the second they pull your file. Your credit score is the first filter, and while FHA loans will technically work with a 580, The interest rate differential between a 620 score and a 760 score on a $250,000 mortgage can translate to $90,000 in additional interest paid over the life of that loan, which means your credit score is not just a number, it is a price tag on your ignorance or your discipline, and the choice of which one it becomes is entirely yours. Your debt-to-income ratio is the second filter. Lenders want to see your total monthly debt obligations sitting below 43% of your gross monthly income, which means that $450 car payment, that $200 in minimum credit card payments, and that $300 student loan bill are not just annoying line items in your budget. They are actively shrinking the mortgage you qualify for by a number that would genuinely shock you if you ran the math right now. And your employment history is the third filter that nobody talks about. Conventional lenders want to see 2 consecutive years of documented income, which means if you are a freelancer, a gig worker, or someone who recently switched industries, your path to approval requires additional documentation and preparation that a W-2 employee simply does not need. Get these 3 pillars aligned before you do anything else, because everything else in this video builds on this foundation and collapses without it. I need to dismantle something right now that has been sitting in your head, probably since the first time someone older than you talked about buying a house, and it is costing your entire generation years of unnecessary waiting. The myth that you need 20% down to purchase a property in America. That number, 20%, was relevant in a different economic era, and repeating it today as universal advice is the financial equivalent of telling someone to use a paper map because GPS might have errors. The actual landscape of low down payment options available to first-time buyers in 2025 is remarkably more accessible than the 20% mythology suggests. And understanding these programs is the difference between buying this year and buying in 4 years after you have spent another $60,000 in rent. FHA loans allow 3.5% down with a 580 credit score on a $250,000 home that is $8,750 instead of $50,000. And yes, there is mortgage insurance attached to it, but the opportunity cost of waiting years to avoid that insurance is mathematically indefensible for most buyers. Conventional loans through Fannie may have a program called Home Ready, and Freddie Mac runs Home Possible. Both allow 3% down for first-time buyers with income at or below 80% of the area median, and both allow down payment funds to come from gifts, grants, and community assistance programs, which means your down payment does not have to come entirely from your own savings account. And if you have served in the United States military in any capacity, a VA loan is giving you the most powerful home buying instrument in this entire country: 0 down payment, no private mortgage insurance, competitive interest rates, and a funding fee that can be rolled directly into the loan. And the fact that less than 33% of eligible veterans are utilizing this benefit is one of the most staggering financial awareness gaps I have ever encountered. Pick the right program for your specific situation. Automate your savings into a high-yield account earning 4 to 5% APY, and stop waiting for a perfect down payment number that the market invented to make you feel like you are not ready. Everything you have built financially means nothing if you deploy it into the wrong property in the wrong market. And this is the chapter where first-time buyers make emotional decisions that haunt them financially for the better part of a decade. The first principle you need to engrave into your decision-making process is that your first property is an asset before it is a home, which means the neighborhood's appreciation trajectory, the rental demand in that zip code, the quality of the school district even if you have no children, and the proximity to employment centers all matter more than whether the kitchen has the island you always imagined or whether the master bedroom gets morning light. You are buying a financial instrument first and a living space second, and the buyers who internalize that distinction are the ones who look back 5 years later at an equity position that opened every subsequent door in their financial life. The second principle is to get pre-approved before you fall in love with anything, because walking into a property emotionally invested without knowing your exact purchasing power is how buyers end up stretching beyond their qualification, accepting unfavorable terms under pressure, or worse, getting outcompeted by a prepared buyer and spending 6 more months in an apartment convincing themselves the market is the problem. Find a buyer's agent who specializes in first-time purchases in your target market, communicate your parameters with absolute clarity, and trust the process enough to make decisive moves when the right opportunity appears. Because in most competitive markets, hesitation is not caution, it is the most expensive decision you will make. Here is what I need you to understand as this video ends. The window for buying your first property before 30 does not stay open indefinitely. Every month you wait, appreciation in recovering markets is compounding against your entry point. Every month you wait, another rent payment transfers your money permanently into someone else's balance sheet. Every month you wait, the version of you that owns an asset instead of renting one gets pushed further into the future. But here is the thing about that window, it is still open right now. The programs exist. The markets exist. The strategy one just walked you through exists. What happens next depends entirely on whether you treat this video as entertainment or as a blueprint. Now, I am going to release a follow-up video that covers something most first-time buyers never even think to ask about, and it is the single most important question you can ask before you make an offer on any property. And the answer to that question has saved buyers from catastrophic financial mistakes more times than I can count. If you want to be there when that video drops, you already know what to do. Subscribe, hit the notification bell, and drop a comment below telling me where you are right now in your home buying journey, because your comment might be the exact thing that shapes what I cover next.